buying a vertical spread. Again, always want to reiterate the building blocks behind these. One of the blocks, the max profit when buying a vertical spread, the max profit is the difference between the strikes minus the net cost of the spread. So back to our original example, and then we're gonna start to hammer some examples that are above and beyond over here. But in our original example, what did we do? We went out and again, we buy the 105 call. We sell, for instance, the 110 call. Buying the 105 calls, $3.50. What did we collect on these little guys? $2. Okay. Now remember, we can always sell an option that we did not own, and this is actually done as one transaction to make this crystal clear. On any brokerage application, you can trade spreads. Some people are aware of that. Some people are not so aware of it, but you can actually trade the spread. So the spread, right, will come out into one piece, meaning that this trade will load up as a buy 105 call, okay, sell the 110 call, and it'll actually show it, all right, and it'll be for a net debit for $1.50. Now, the max profit when buying the vertical spread, it's the difference of the strikes, which is $5, minus the net cost of the spread. What's the net cost of the spread? $1.50. So the difference between the strikes, $5, minus the net cost of the spread, which is $1.50, equals how much can you make on the spread? $3.50, minus the transaction cost, the maximum loss when buying a vertical spread. Maximum loss equals the net cost of the spread. Well, so what's the max loss over here? Okay, it's what you paid for the spread, which happened to be none other than $1.50. Again, I like to kind of scope this out with you, even though we're going through, again, what kind of feels like a little bit rudimentary and some of the basics of spreads, and you can read about this stuff anywhere. Got to look at the difference between the strikes and the net cost of the spread and be able to identify those items right now. Because again, these are the items that are going to be used in our discussion of probabilities, and we're going to go extensively into probability discussion, all right, in kind of part 2 of this Options 201 to kind of continue on this theme over here, profit and loss graphs. Now, the following graph will illustrate if you buy a 30-35 vertical call spread, buy the 30 call, sell the 35 call for $1. To open a position, the maximum profit can be made as what? Well, first of all, it's a $5 wide spread. It's the first thing you want to identify. And in a $5 wide spread, what's the most you can make? Okay, well, the most I can make is $5. So again, the first thing you want to identify, it's a $5 wide spread, of which it looks like you went out and paid $1 to open the position. So all you got to do, 5 minus, okay, the buck comes out to $4. Math is done right there. The maximum loss of the risk in the trade is the $1 you paid for it. Okay, so that's the max risk. You're risking, for the most part, in contracts, if you did one contract, $100 for the opportunity to make up to $400. That's a 400% return on the investment. The following chart shows the profit and loss on this trade at expiration. So I don't go too deeply into profit and loss graphs. Now, I put this together, and I built it on a spreadsheet outside of any trading application just to familiarize yourself with profit and loss graphs. Not all profit and loss graphs are going to be identical, but again, to familiarize yourself with the profit and loss graph, because some of you might be brand new to this and make you the most effective doing this. The first thing, this is a call spread risk graph. All right, easy enough. The first thing you need to know, at expiration, most risk graphs, okay, are what we term, you'll see at X. This is actually the shorthand for at expiration. So I actually wrote it out on this particular slide though, but I got to stress to you, at expiration sometimes looks at things worst case scenario, sometimes looks at things best case scenario, depending upon the trade. I find risk graphs at times can be extremely misleading. Okay, there is a great deal of inaccuracy in the options industry relating around risk graphs. What I'm telling you is that if you spend your time looking at risk graphs, you'll always come up with this risk graph. You're like, oh yeah, it looks like this, and then oh yeah, but this might be at expiration. Okay, what have you got over here? This is it's a hamster trade. It looks like a hamster and some kind of a wheel. Oh, this thing is great. It's also at expiration, and at expiration means you've actually carried this position to the last possible moment. Now, I'll show you the risk graph, but again, I will reiterate my stance 100 times over. And 15 years watching people look at risk graphs, and I help build some of the risk graph technology, okay, that happens to be on Thinkorswim, and some of the feature set on there. I am telling you that these risk graphs not only are overused, but they tend to be used as, weapons against clients, because people assume that that's what they're really going to make. And the risk graph, this lives in a fictitious land of expiration, because most trades have no idea. They're not going to go to expiration. They're not even going to come close to expiration. So don't live in Never Never Land. All right. And for years, I've actually called risk graphs Never Never Land. You guys know what Never Never Land is, right? Yeah. Okay, so everybody's like aware that's where, large animals are flying through the sky and whatever. I don't want to get too deep into this, but in the risk graph in this case, the value of a long 30-35 call, I think this really accurately depicts your risk. And what you realize is, so here's a stock, and the stock right now, okay, the assumption is the stock might be right at $30. So assume the stock is right at $30. Which it is. So stock at $30. And again, that's my nickname. I don't like that ABC or XYZ crap. No, stock is at 30. That's the name of the company. It's stock. And stock's at $30. What's the probability of the stock going up? The probability of the stock going down. Don't tell me what you think. Tell me what you know. All right? It's about a 50% chance going up, about a 50% chance going down over here. All right? The world lives on a distribution curve. That's it. So what I want you to recognize is, yeah, it could go down here to 29, but the same probability of it going up to 31. You can get up to 32, but at 32, I'm making pretty good money. If it goes down, all right, all the way here to 28, I'm a loser. How much am I going to lose? The most I can lose over here is $1. If I go down, I lose 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 $1. But I like this. Because over here, what do I lose? If the stock stays flat, I lose $1. But if the stock actually goes up $1, 0. Then what do I make over here? +1, +2, okay, +3, for instance, +4. All right, and that's the way to actually look at this in terms of risk graphs and so forth, is to just recognize what dollar for dollar you're making or dollar for dollar you're losing over here. Okay, again, I can't stress this enough. This is some of the importance of really understanding a risk graph. People don't really explain it this way. Is it's a 50-50 shot in the world. But if the downside only lose $1, but the upside is you can make as much as 4, I don't know about you, but I think that's a pretty good 50-50 shot. All right? But really, you need the stock to go up $1 just to be able to break even on the little monkey, because it's a 30-35 spread. So here's the 30 calls. All right? And those are the ones that were buying, and then we're doing what? They're 35 calls. Those are the ones that we're selling. Doesn't matter the individual prices, matters what the net spread is trading for, and the net spread is trading for $1. Okay. Yes, Never Never Land. I like it. I mean, so when you look at this trade and you're trading for $1, okay, you need the break-even point is going to be what? Where the stock currently is, and right, this is where you actually went out and purchased that spread as a 30-35. The break-even point here is going to be 31. And we're going to go through that again many, many times. You bought a 30-35 call spread for $1. Break-even point is 31. And I want to make sure everybody's just aware of this. I mean, but the probability of going all the way up here is not necessarily 50-50, but there's a 50-50 shot of the stock going up or down. But I like it where you're in a position, you have a lot more upside potential than downside potential. Okay, think about it. And it's a very limited risk position moving forward over here, because there's a few more concepts call it a day, and we'll come back and get the rest in part 2 over here. The max profit, max loss. And by the way, one of my favorite slides is coming up over here, and I think you guys are really, really going to appreciate it. It took me a long time to put it together, but the max profit and loss. Buy to open the 30-35 call spread. Buy the 30 call, sell the 35 call. The max profit, okay, occurs above 35. We saw that. The max loss at expiration, below 30. So, as I said again, this is just going through another example. So, in buying the 30 calls, all right, selling the 35 calls. Remember, the whole spread is done for one debit, $1 debit, because that's what it's going to cost you right out of your account. Now, again, the max profit, it's a $5 wide spread. So identify the spread. $5 equals width. $5 equals the width, of which you paid $1 up front. So what's the most you can possibly make? $4. All right. So max loss at expiration, limited to $1. Max upside potential, $4. It's a $5 wide spread. If you can identify those items, you're ahead of the curve already. Okay. Just identify these 3 items: the debit for the spread, the width of the spread, and what you can actually make. Because these 3 items are going to be used to, again, calculate probability moving forward. Break-even point is even secondary. All right. I like to mention the break-even point because it's kind of the point to where you get your money back over there. Now, by the way, we're going to do trades where we risk 1 to be able to make 1. We're going to do trades where we risk 2 to be able to make 1. We're going to do trades where you risk 1 to be able to make 3. But this is the way to initially get you to understand spreads. The building blocks of all of it is just buying the vertical spread. Okay, so we'll cover all of that. Now, this is the reason why I teach this first, is I wanted to do a compare and contrast. And, you know, this is something I've seen others put together in the past, but I really, and, you know, a friend of mine showed this to me probably like in 2000. All right, so my friend showed me this in 2000, and it was just a graph. And I'm going to explain exactly what this is. Buying a call versus buying a call spread. So again, when people first get involved in trading, they're always taught to like, hey, just go out there, buy a call. Over here is buying the what? The spread. So this is buying a call, buying a spread. Now, buying a call, the stock price is at 30, 31, 32, 33, 34, 35, 36, 37, right? The call is costing us, right? Closing the call bought for $2.50. So the call is costing us $2.50. So you buy a call, and that call happens to be the 30 call. We're going to buy it for $2.50. Okay? Duration isn't that important. We're also going to buy a spread. That spread is going to cost us approximately $1. Now, this is all on the exact same stock. Okay. What I want you to see is the cost of the trade is $2.50. If the stock stays at 30, you lose $2.50. It's 100% loss. If the stock drives to 31, okay, what's a 30 call worth with the stock trading at 31? What's a 30 call worth with stock trading at 31? Well, it's going to be worth what? $1. But you paid $2.50 for it. So what do you lose? $1.50. You'd still lose 60%. With the stock at 32, what's a 30 call worth with the stock trading at 32? It's at expiration intrinsically. The real value is worth $2. But you still paid $2.50 for it, so what do you lose? 50 cents. It's still a 20% hit. So the stock now has already moved up $2. Remember, this stock is at 30. So stock at 30, you lose 100%. Stock at 31, you lose 60%. The stock at 32, you still lose 20%. The stock at 33, it's a miracle. Stock at 33, you make what? $3, but you pay $2.50 for it. So what do you make? 20%. Stock goes to 34, you make $4, 60%. Guys, see where I'm going with this? The stock has to go, what? Up $6, which is probably not going to happen, at least in your time, frame, and you're only making 140%. The reason I like to put it right up against the spread, this is the 30-35 call spread. 30-35 call spread. What did we pay for it? We paid $1 for it. Okay? Now, the max loss. Is there a way you can lose more than the maximum? No. Unless there's a dividend. Okay, there's always an odd man out over there. But you pay $1 for the spread, the most you can lose is $1, unless you completely and totally fell asleep at the wheel. And through options, that can happen. In either one of these options, you could fall asleep at the wheel. The option could technically be exercised or assigned, and you could possibly turn into stock and take a greater loss on the stock. Nevertheless, if you get out before the expiration, your risk is defined to $1 or defined to $2.50. The point I want to make, though, here's a 30 call, here's the 35 call. Now, you're buying, in this case, a 30-35 call spread, and you're paying, again, $1 for it. Buy the 30 call. If the stock stays at what? 30, what are you going to make? On the 30 call, 30 call is worth nothing. 35 call is worth nothing. What do you lose? 100%. But if the stock goes right to where? 31. So now this is the stock at 31. What's the 30 call worth when the stock's trading at 31? It's worth $1. 35 call goes out worthless. What do you make on it? 0%. Now, if the stock goes up to what? This is 32. You make $2 on the 30 call. The 30 call, what's a 30 call worth with the stock trading at 32? It's worth $2. You make 100% for a $2 move in the underlying. At nowhere did you make even a, 100% had to have a $5 move over here. So when people argue that like spreads give up your upside, it's the most ridiculous argument. That's why I always say like buying calls is reckless. If you get like somebody that's teaching about buying calls and actually teaching trading around buying calls or buying puts, it isn't just reckless. It's because they don't understand one of these most simple examples. All you got to do is putting buying the call next to buying the spread in any product. And in the most simple terms, it doesn't pay. It just doesn't pay. You're like, but you could make more money on the call. How? You don't see a 400% return anywhere on buying a call. This thing gets 400% returns on your money. Okay? For what? A $5 up move. This only gets, buying the call only gets 100% return on the money. Let me just, real simple. What do you want? Do you want a 400% return on your money? But I apologize. Your upside over here is capped. Your upside's capped, but you get a 400% return. Or do you want unlimited upside potential? I just will hammer this to death because when I say buying call is reckless, I am being so incredibly nice about that. It isn't just reckless, all right? It's insane. It means we don't understand basic math. Traders use spreads in every way, shape, or form. Anybody that has experience in options uses spreads. Okay? Not even to mention that, do you know the exchanges actually give you better deals for trading spreads because they're much safer trades in the market? Something I'll have to explain later in this class over here. But this is the stock now going up to 33. What's a 30 call worth when the stock is at 33? A 30 call is worth at least $3. The 35 call goes out worthless. You make 200% for a $3 move in the underlying. If you just buy the call, you make 20%. What do you want? You want 20%? You want 200%? That's why I say reckless. It's not reckless. They don't understand math. Basic math. Don't buy calls and don't buy puts. Use spreads. Okay? At TheoTrade, everybody that's going to get through this, all right? Yes, we might buy a call or buy a put on an intraday basis. We get in, we get out. But holding a call overnight or holding a put overnight, it's reckless abandonment. You must use spreads to mitigate our risk. We're always going to be willing to give up the upside to protect our downside. And the reality is, giving up the upside, the way I see it, the upside is still phenomenal inside of the spread versus the call. And I'll tell you what, so I'm going to leave off on this part one over here on this particular slide. And we're going places with this. Okay? We are going places with this because I'm going to reiterate this tomorrow when you're going to learn spread takes the case. In almost every single case, a spread needs substantially less movement in the stock price to become profitable than does buying a call or put. Okay? Combine this with the fact that spreads reduce capital investment and limit risk. It makes this the bread and butter plays of TheoTrade. And that's, again, spreads are going to be everything. So buying a call, buying a put, run. Don't I mean, don't even think about doing it. And that's why I put together this slide just to enunciate that. And I can do this, okay, and I will do this tomorrow in the live market. So we'll go into the live market tomorrow, and we'll actually look at detailed examples before earnings, after earnings. It doesn't matter. The spread always takes the cake when it kind of comes to options trading over there. With that, we'll be back. Part 2 coming up over here of Options 201. Much more to come. Remember, it's just part 1 of vertical spreads. Part 2, we're going to include probability. We're actually going to talk about what's called creating a box, okay, a box spread. It's essential to understand the box spread for your future capabilities in other trades, like iron condors and butterflies and iron, butterflies and broken wing butterflies and ratio back spreads. We're going to understand the box. It's going to help you out substantially in there. We're also going to get, again, detailed into probability and price. Thanks a lot, everybody, for joining me here at TheoTrade for the Options 201 Verticals and Calendars Essentials. Be back with part 2.